Welcome everybody to our webinar today, or Aminar as we like to call them, called Understanding the Main Street Lending Program, Funding Forward. Please post your questions in the Q&A only. The recording of this webinar and slides will be posted shortly afterwards on our community site at realtime.inc.com, and later in the day we will also email a copy to participants. Briefly about myself, I am the founder and CEO of MultiFunding. I write regularly in Inc. magazine. I've advised the prior administrations as well as the Federal Reserve on the business credit markets. I have a book out on Amazon called The Growth Dilemma. And for my entrepreneur organization friends out there, I'm a proud board member of EO Philadelphia. My attorneys asked me to share some disclaimers. We are in an unprecedented time in history, and the information available to us is changing rapidly. Please refer to our most current presentation for education. The information provided is based upon our best judgment about what we know at this time. However, key questions remain about how to implement this program. MultiFunding LLC does not accept any liability as it relates to the timeliness or content of the information we are sharing today or may share in the future, and we are under no legal duty to update any such information or recommendations. We encourage you to check in with your attorneys, CPAs, and financial advisors for additional insights. This is the time for us to be reimagining our business and thinking about what is next. And as part of this process, we need to figure out our strategy. Will we pivot 5%, 50%, or 90%? We need to figure out what our team is going to look like that we go into this battle with. And we need to prepare our ammunition for this battle. And in this context, ammunition is cash. And in any battle, you need ammunition for offensive and defensive purposes. How much cash will be required to get your business back up on a stable footing? What is the best case and the worst case situation? And where will the cash come from? And what does your future look like? And what are the opportunities to consider? These are the important things that I would like everyone to think about the Main Street Lending Program that is part of the CARES Act. Good news is, as of this morning, the feds extended the program to now go until December 31st, 2020. It is comprised of 3 programs: the new, the priority, and the expanded. Some context is important. The Main Street program is not an entitlement program like PPP. If your business has been badly hit by COVID-19, your best chance for a Main Street loan will be through your existing bank. But if you plan to use a Main Street loan to expand and grow, more banks will be open to you. The program is live. Most participating banks are now up and running. The Federal Reserve has put a list of participating lenders on the website. However, this list is not 100% accurate. And as of this morning, the program has been extended until December 31st. It's important to understand what the motivation of lenders is for participating in this program. If you have your existing lender and you have a large amount of debt with them already, they are motivated to get you one of these loans to lever their bet and give you some more wiggle room and time to survive this economic downturn. And if you are going to a new lender, they will be looking for strong credits and new banking relationships. There are about 400 banks, savings associations, and credit unions across the country participating. To be eligible to participate, your business must be established prior to March 13th, 2020. If your business has more than 15,000 employees or 2019 revenue in excess of $5 billion, you're too big to participate. And you have to be created or organized in the United States with the majority of your operations in the United States. To be past the US SNF test, more than 50% of your assets must be in the United States, and your net income must be generated in the United States, net operating revenues generated in the United States. Subsidiaries of foreign companies can apply as long as they can attest that they will not send the money up to their parent. Eligible business types include partnerships, LLCs, corporations, associations, trusts, cooperatives, joint ventures with no more than 49% participation by foreign business entities or tribal business concerns. Sole proprietors are not eligible to participate. and nonprofits are eligible, but through a different program. Ineligible borrowers include developers and landlords in certain other industries, such as private equity companies or industries that the government considers to be speculative. If you are part of an affiliated group of companies, affiliation rules apply, and the affiliated group's loan amount cannot exceed the maximum loan amount for the facility, and you can only pick one facility to work with, the new, the priority, or the expanded. Now let's dig into the new and the priority. These programs share some commonalities. They are secure or unsecured term loans. They have a 5-year maturity. Principal payments are deferred for 2 years and interest payments are deferred for 1 year. So you pay 15% at the end of year 3, 15% at the end of year 4, and 70% at the end of year 5. They are priced at an adjustable rate of LIBOR plus 3%. So right now you can assume you'll pay 3.31% annual interest for these loans. Prepayment is permitted without penalty, and the initiation fees or to get in will likely be 2%. The new facilities start at $250,000 and they go as high as $35 million. So how much do you calculate how you might be eligible for? So if you take a company with $500,000 worth of 2019 EBITDA, let's take row number 3. If that company's maximum loan they could get would be $2 million or 4 times that. If that company had an existing debt of $1.5 million, their potential new money loan would be $500,000. If that same company had $500,000 worth of debt in row 1, they could get a potential new money loan of $1.5 million. What's important about these loans is that in case of bankruptcy, the new lender must have the same rights as other lenders except for your mortgage. So you have to, if you're going to keep other lenders, negotiate intercreditor agreements with them in terms of how things happen in bankruptcy, but in the normal case of business, the new lender's rights can be subordinated. These loans can be secured or unsecured depending upon what you work out with your lender and what other loans you have. And you are able to take additional debt after you take the loan as long as they do not interfere with the rights of the lender. The priority facilities can be bigger. They go from $250,000 to $50 million. So to take that same example of that company with $500,000 worth of EBITDA, and in row 3, they could get a $3 million one or 6 times their 2019 EBITDA. That company had existing debt of $1.5 million, their potential priority money loan would be $1.5 million. If that same company only had existing debt of $500,000 in row 1, their potential priority money loan would be $2.5 million. What is unique about this program is that you can refinance other debt into it as long as it is not debt from the lender that you're getting the loan from. And in these loans, the lender's rates have to be senior or on par with all other lenders in bankruptcy and in normal times, except for your mortgage. Like the new facilities, these loans can be secured or unsecured, depending upon what you work out with your lender. The expanded facilities are a little bit different. They start at $10 million and they go as high as $300 million. And if you're going to be eligible for one of these, it has to be with your existing senior lender. Take an example, in row 2, a company with 2019 EBITDA of $10 million, their not to exceed would be $60 million. If that company had existing debt of $50 million, they could get a potential expanded money loan of $10 million. If that same company had $25 million worth of existing debt, they could get a potential expanded loan facility of $35 million. In these loans, the lender's rights tag along with the existing lenders, and they have share other commonalities, except the fees to get in are lower, between 0.75 and 1.5%. Lenders here agree that they will not use these money to pay other loans except for loans that they refinance as part of the transaction in a priority loan. They commit to not use the money to pay down other lines of credit or shut them down while you have the loan. And you commit that you attest that you have no reason to believe that your company will go bankrupt in the next 90 days. While you have the loan, you can repay your line of credit or credit cards in the normal course of business. You can take on additional debt obligations as long as they do not interfere with the rights of your Main Street lender, and you are allowed to refinance maturing debt. You do agree to follow certain compensation requirements. There are capital distribution restrictions. There are exceptions for this for S corporations or other tax pass-through entities. While you have the loan and for up to 12 months after you have the loan, you agree not to pay dividends or make other capital distributions with respect to the common stock of your business. For those who earned between $425,000 and $3 million in 2019, you agree while you have the loan and for 1 year after that not to exceed that amount. And if your compensation was in excess of $3 million, say it was in $6 million, you take half the difference between 3 and 6, say 1.5, you add it to the 3, and then your compensation is capped at $4.5 million. While you have this loan, you attest that you'll make reasonable efforts to retain your employees, but unlike PPP, this program is focused on saving the company and not necessarily saving the jobs. Your lender will calculate, if you're working with a lender you've previously worked with, they will calculate your EBITDA in the same way they historically have. And if it's a new lender, they will have to be required to calculate EBITDA or proposed adjustments in the way that they have done it for similar companies like yours in the past. Your debt will be calculated on the date that you apply and will include all existing and outstanding debt from banks and private lenders. If you have an asset-based line secured by accounts receivable and inventory, what will account that day is the amount that is you have out on the loan, not the amount that you could borrow. So how do you pick between the new, the priority, and the expanded? So if you take row number 2, a company with $4 million of EBITDA and $10 million worth of existing debt, they could get a new of 6, a priority of 14, or an expanded of 14, and they would have to work with their lenders to figure out what they could get, who would be willing to give up what rights, as well as what they were eligible for from a financing perspective. Financing strategy, my friends, is a combination of offensive and defensive. I'll share with you briefly 3 strategies that different borrowers are using to look at the Main Street loans. One is a company with a $3 million line of credit and $1 million drawn. They are planning on getting an MSLP for liquidity. They would rather not draw down their entire line. Another is a professional services firm whose partners will take at least a 50% hit in 2019 in salaries due to COVID-19. They plan to take an MSLP to spread their income hit over 5 years instead of 1. And example number 3 is a company that has already been approached by several competitors who plan to close shop. They plan to acquire companies at pennies on the dollar and use the MSLP money to help. How much cash will be required to get your business back on a stable footing? What is the best case and the worst case scenario? And where will this cash come from, and how will you use it, and how will you fund it? And as you ponder your future, what options are you considering, and are you certain to get the right ammunition in your war chest for that now? That is the end of my prepared remarks. We're now going to open up all your questions in the Q&A. Thank you so much.
Thank you, Ami. If we apply to receive the EIDL loan, can we still apply for the Main Street loan?
Yes.
How many banks are participating in the New York and New Jersey area?
Mal, I don't know the exact number, but I'm going to say probably, 15 to 20. I think I saw someone raise their hand. I'm going to ask you to please post your question in the Q&A instead of raising your hand. So happy to take any other questions. Questions going once. Feel free, folks, if you have any questions, we're happy to take them. Questions going once. Questions going twice. Okay, so we appreciate you taking the time to be with us today. If you have any questions or thoughts, you can feel free to email us. And we know it's tough out there, and we wish everyone God bless and Godspeed as you make your way through all this. Take care for now. Bye-bye.